Hey, hello everyone. My name is Diego Rios. I'm a real estate agent with West USA. And today I want to share with you this report about how is the real estate market in the month of August 2022. So, quiero compartir con ustedes este reporte de cómo está el mercado de bienes raíces. El reporte nos lo va a presentar Kate y pues ya, los invito a que se queden con nosotros y podamos discutir alguna pregunta que tienen después de este webinar. Thank you.
Welcome to your monthly market report for August of 2022. My name is Kate Rezebek, and I'm thrilled to be here today to share with you three of the most important topics that you definitely want to be right on top of in the housing market today. We're going to be talking about what's happening in the current market, why the market won't crash, and the big one that everyone wants to know, what's ahead for the forecast for the rest of the year? What are the experts saying about the rest of 2022? So I'm going to jump right in with our first topic, and we're going to get started with what's happening in the current housing market. Now, I think we can probably all agree that this year is really defined by rising mortgage rates. And what you're looking at here is the Freddie Mac 30-year fixed rate from January all the way through to the latest data we have today. And what we can see over time is that mortgage rates really ticked up week after week after week. And, they started to potentially peak right around the, mid-June, end of June time. And now we're seeing a lot of volatility. So when I say they've peaked, definitely not out of the woods yet. Signs, yes. But mortgage rates are showing a lot of volatility right now. And, where we are today, a little bit lower than where we were about a month ago, but we're still watching them. And, a lot of this has to do with the moves that the Federal Reserve is making to ease inflation. Now, we've said for a while, if you've been following along with us, that inflation is the enemy of long-term interest rates. And that's exactly what the Fed is trying to do. They're trying to ease inflation. And as that starts to happen, as we saw in the last Federal Reserve meeting, they raised the federal funds rate by 75 basis points. Now, when that happens, that doesn't dictate where mortgage rates go, but it started to signal that maybe the Fed is getting inflation under control. Now, we're still watching that for sure, but as that starts to happen, the fear of recession comes into the conversation. And those who, are calling all these shots and looking at this, and we're seeing a lot of chatter in the media, we're starting to talk about what happens if we're in a recession. And, I think that's the piece we want to follow because I'm going to set up for you today, what history shows us about what happens in the housing market during recessionary times. And a lot of times what we've seen, history shows us that mortgage rates typically fall during a recession. So that's a big piece that we're going to set up today. And, the question is, are we in a recession? Well, the National Bureau of Economic Research, this is the group that defines what a recession is and when it is, says a recession is a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Now, whether or not we're in a recession right now is really kind of up for debate. It's actually become a little bit political in this country, and I'm not going to get into that aspect of it, but I will set up the argument for you. And, this is the technical definition of a recession, but what we also know is the widely held belief that a recession is 2 consecutive quarters of negative growth. And if you look at this chart right here, you can see that going all the way back to the 1940s, the late 40s, every time we've seen 2 consecutive quarters of negative growth, a recession has been called. So I don't recommend you get into a debate with your clients as to whether or not we're in a recession, but this is definitely the talk that's starting to cause fear and concern. And the reality is, what we want to break down in the housing market is what the data says, and why not to fear a recession for the housing market. And if you talk about what the experts are saying, this is a survey from the Wall Street Journal that, the Wall Street Journal asked economists if they believe a recession will happen in the next 12 months. And the percentage of economists who said yes a year ago was only about 12%. But look at how that has ticked up over time. And in a year's time, half of economists say that, we're headed for a recession in the next 12 months. So well, we can talk about what's happening in the world around us. We can, really hear all of the chatter around us. The question that we want to be able to answer is, how would a recession impact? How would the housing market be impacted by a recession? Whether or not we're here right now, the data and what we want to do is follow the data and what the data tells us about, historical context. And that's, as the experts, what we can share with our clients. And, recession really just means an economic slowdown. So if we look at what the data says, a recession does not mean falling prices. If you followed along with us for a while, you've seen us pull this visual up quite a bit. And what it shows is that in 4 of the last 6 recessions, home prices have actually appreciated in value. Now, we all remember 2008 when home values lost nearly 20% value, but that's really a very fundamentally different place than where we are today. The market was drastically different. We're going to break down a lot of that today in your monthly market report. But truth be told, 4 out of the 6 past recessions, home prices have actually appreciated. And I mentioned this a moment ago. What does this also mean? A recession also means falling mortgage rates. Now, as we look at the data about what happened with mortgage rates over the past 6 recessions, those have also declined. That's what you can see here. This is the decline, the percentage points decline in mortgage rates over the last 6 recessions from the peak to the trough. So, you can see every time mortgage rates have ticked down. So that could be really good news for the housing market, for those buyers who have maybe been, paused in the process or stepped out of the home buying process because they've been priced out by high mortgage rates. Mortgage rates declining could be a very good thing. And if we look at this graphically, what we can also see, this is a combination of data from Freddie Mac and mortgage specialists. It shows how from the peak of the recession to the trough, each of those yellow boxes that you can see across this graph, how mortgage rates have fallen in recessionary times. Now, this doesn't indicate exactly what will happen every single time, but we can learn quite a bit from what history shows us. And I think this quote from Fortune really helps as well. It says, over the past 5 recessions, mortgage rates have fallen on average of 1.8 percentage points from the peak seen during the recession to the trough, so top to bottom. And in many cases, they continue to fall after the fact, as it takes some time to turn things around, even when the recession is technically over. So what does this mean? It means if we look back at what we've seen historically, mortgage rates have fallen in times of recessions. The question we want to be able to answer for our clients who may have concerns about a recession is, what does this mean for the housing market? And this is exactly what we can share with them. Those visuals on recession doesn't mean falling prices. Recession means falling mortgage rates. Those are huge to get out there and share and make sure your clients understand what traditionally happens in times of recession in the housing market. And that may be a great time for them to jump back in. And it may be one of the reasons why housing actually helps us into this soft landing that we keep hearing about. So with that in mind, let's talk about another big question that's on everyone's mind, and it's about a housing crash. And what I'm going to break down for you is why the housing market won't crash. And I think that the heart of this is in inventory. Now, we know that there are 3 places where inventory comes from. It comes from existing homeowners or current homeowners listing their homes, putting them up for sale. It comes from new construction, so newly built homes coming onto the market. And it comes from potentially distressed properties, so short sales, foreclosures. So what I'm going to share with you today is, where is inventory coming from today? And when we look at, the inventory perspective, why that means the housing market won't crash. If you think back to the last time when the housing market crashed in 2008, we had an oversupply of homes on the market. And today we have an undersupply. And anytime there are there's an oversupply of homes. So more homes available than buyers who want to buy them. We've talked about this a lot, but that's what causes prices to fall. And what I'm going to share with you today is why that certainly isn't the case. And like I said, it starts with the fact that we just don't have enough homes for sale on the market. This is a look at, existing inventory. And today, the total housing inventory registered at the end of June, the latest data that we have, was 1.26 million units. Now, if we look at that from a month's supply, that's what you're seeing right here. Unsold inventory today is at a 3-month supply. That's a little green bar that you can see over on the right. Now compare that to the red bars. That's the oversupply that we had during the housing bubble when the market crashed. That's because we had more homes on the market than we had buyers to buy them. We have the exact opposite today. And if you look at this comparatively, where we are today is nowhere near the oversupply we had last time. Now you would have to build a case that a flood of homeowners are getting ready to sell their houses. They're going to jump into the market. They're going to make a move, and all of this inventory is coming to the market that would actually tip the scales into that oversupply zone. We're just not even close to being there. The typical neutral market is 6 to 7 months of supply of inventory. We don't even have half that at this point. So although we know this number is growing, and we are keeping an eye on that because more inventory is coming to the market, that's the tick up we're seeing this year. We certainly aren't anywhere near where we could potentially see the market crash because of so many homes coming under the market. Now, the other place where inventory comes from is new construction. This is a look at monthly new residential construction. We've broken it down into the 4 stages of construction: building permits and housing starts. Those are our leading indicators that tell us where the market is headed. And then on the bottom, under construction and housing units completed. Those are the lagging indicators. What's happened so far? And what we can see in terms of the leading indicators, the 2 at the top, permits and starts, those are slowing down from May to June. You can see that happening. And that's because builders are saying, hold on, we're seeing mortgage rates rise. We're seeing that softening buyer demand. We're not going to overbuild. We're not going to get started on more homes than we know we can complete. They're really being cautious right now. And so while we've had 14 years of undersupply of newly constructed homes built in this country, they're not going to overbuild at that time. And that's the little tick down that you can see. So slowing there. And if you look at the bottom, especially down at housing units completed, you can see that we're headed to build a seasonally adjusted annual rate of about 1.3 million homes this year. Now, that's wonderful. That will add more inventory to the market. It will help really, create some options for home buyers, but we're not on pace to have an oversupply. You can see that May to June tick down on units completed. So, we are definitely seeing more new construction. We're on pace to build 1.3 million homes in this country. We haven't seen that in over 14 years. That's huge. That's a wonderful addition to the inventory, but not anything that would take us to an oversupply like we had when the housing market crashed. Now, the third place where inventory comes from, we've talked about this quite a bit over the past couple of years, is foreclosures or short sales or distressed properties. The reason we're not going to be seeing a flood of foreclosures, a big part of that is because lending standards are under control. Now, back when the housing bubble burst, we had much looser lending standards. They've tightened up significantly, and that's what this graph shows. This is the Mortgage Credit Availability Index, and it shows the higher that green line is, the easier it was to get a loan. And what you can see in 2006, 2007, it really peaked where, we used to joke that it was harder to not get a loan than to get a loan. It was much easier for someone to secure a home loan, and that created, inflated demand, and many, many millions of people were foreclosed on their homes because they weren't coming to the table as a qualified buyer. and they weren't able to repay their loan over time. Now you can see that that green line really drops off 2008, 2009. That's when lending standards really tightened. That's when we were required to have a more qualified buyer. So those who are securing home loans today, you can see that green line really hovering along at the bottom, are much more qualified buyers, more likely to repay their loans and not go into foreclosure. So that's a huge difference that we have today. And if you want to see the results of what this has done to foreclosure filings, look at this right here. This is US properties with foreclosure filings, and it shows foreclosure activity by year. You can see those red bars are when we had over 1 million foreclosures per year, 1 million foreclosure filings per year in the housing market. And the lending standard tightening that I showed you did this, made it drop right down consistently, starting especially in about 2011, fewer and fewer foreclosures every year in this country. Now, you can take 2020 and 2021 out for a second because we know we had a moratorium on foreclosures in that time period. But overall, tightening lending standards really changed the game with a more qualified buyer. Now, I want to talk about where we are this year with foreclosure activity, because I think this is starting to come into the conversation as well. And what I want to show you is first half foreclosure activity by year. Now, this is for January through June of every year going back to 2008. So the first half of the year. That's the latest data we have right now. So it's the best comparison for you to see where are we today in 2022, knowing that there are more foreclosures coming back to the market. Now, it's not a flood of foreclosures because what you can see is 2022 over on the right has just under 165,000 foreclosure filings this year so far. We can compare that back to 2020, pretty much on par with 2020, not even as much as we had in 2018 or 2019. So moving back in the direction of, a pre-pandemic year, but not a flood like we had in those red bars where millions of homes were coming to the market as foreclosures. And, I think we can really look at this and say lending standards have changed the game. We know that there are more foreclosures coming to the market this year, but it's nowhere near anything that could cause the market to crash with a wave of foreclosures. So, our hearts go out to anyone who's in this situation. We never want to see anyone go through this process. But, we're certainly not looking at a crisis or a crash that would cause prices to decline significantly because of inventory coming from distressed properties. I think a big reason for that, we've covered this quite a bit over the past couple of years as well, is, the forbearance program. Here's the latest update that we have. This is now a monthly report, and it's the loans upon exiting the forbearance program. So this is current as of the very end of June. And what it shows is that 36% of mortgages coming out of forbearance were actually paid off, brought current, all set, people staying in their homes, no issues whatsoever, just walking away from forbearance, staying in their homes. That's huge. But what's even more important is if you look at this blue section, 45% were workouts or repayment plans. So people who were able to do modifications, loan deferrals, they went back to their bank and they changed their situation. And that's huge. This is the opportunity that homeowners didn't have in 2008 that they have today, is to, work out a plan so they don't have to lose their homes. Banks swore up and down that they didn't want that to happen ever again. And the forbearance program changed the game. So what this really shows is if you put the green and the blue together, that 4 out of every 5 homeowners coming out of forbearance are just fine. They're staying in their homes. They've worked out a plan. They've paid off their loans. Now, there is that orange section of those who are still in trouble. 17% have no loss mitigation plan coming out of forbearance. And so that's created some concerns. But truly, those homeowners with today's growing equity and appreciating home values have enough equity to be able to sell their homes, make a move, and avoid the foreclosure process. So people today have different options that they didn't have before. And that is huge. That is changing the landscape. And one of the biggest reasons why we won't see a wave of foreclosures coming to the market. Right now, we only have about 400,000 homes that are actually in forbearance. And of course, we don't want any of those to go to foreclosure. But even if they did, Even if all those homes, or even if those homeowners all sold those homes, we have such an undersupply of homes on the market today that they'd be scooped up instantly, and it wouldn't cause a crash for the market. So I think this quote from Rick Sharda from Adam Data, this is the group that follows all of this, is really powerful. It says foreclosure activity across the United States continued its slow, steady climb back to pre-pandemic levels in the first half of 2022. Exactly what we just showed you. While overall foreclosure activity is still running significantly below historic averages, the dramatic increase in foreclosure starts suggests that we may be back to normal levels by sometime in early 2023. So while we're seeing more foreclosures this year, that's because we didn't have any in 2020, we didn't have any in 2021, roughly. We're seeing some of those come into the market, but certainly not like we did when the housing market crashed. So I think if we look at this perspective, the three places where inventory comes from today, if you look at months inventory of homes for sale, even if we have homes coming from all three of those places, we're still in a seller's market. That's that green line down on the bottom. You can see where it says today, right in the center. That inventory line is rising. It is climbing, and that is great news for the housing market, but nowhere near those 2008 to 2010 regions where we truly had an oversupply of homes on the market that caused the housing market to crash. So as we think about that, three places where inventory comes from: existing homes, new homes, and distressed properties. Nothing that would cause the market to crash. Really important data to get out to your clients so they can make powerful and confident decisions about, why this market won't crash. It's a big question on everyone's mind, and this data and historical context really helps you frame up that conversation. Now, we've talked a lot about where the housing market is today and why it won't crash, but I think one of the big questions on everyone's mind is what's ahead for the rest of 2022. So let's dive into the expert forecast. What are experts saying is ahead for the rest of the year? Well, we started this conversation today talking a lot about how mortgage rates have been rising since the beginning of the year. And I think one of the big things everyone wants to know is where are mortgage rates projected to go? So this chart is a look at mortgage rate projections that were just released in July from Freddie Mac, Fannie Mae, MBA, and NAR. Now, if we look at these across the board, we can average them all out over each quarter, and that right column shows the average of all four. So what is it telling us? It's really saying that mortgage rates are projected to kind of hang in this steady space right about where we are right now. So mortgage rates being a little bit more stabilized over the next year. So that's great news for buyers who, may have been priced out of the market or, have pressed pause on their plans because mortgage rates have been rising so rapidly. But here's the thing, we're also going to be looking at all of the economic factors around us. We've said a lot that inflation is the enemy of long-term interest rates. So what do we need to do? We need to keep watching where inflation goes. Mortgage rates tend to respond in this case. And, as the Fed makes moves to raise the federal funds rate to ease inflation, we know that that does not dictate where mortgage rates go, but it certainly is part of the conversation. And as we talk about, are we headed for a recession? What typically happens to mortgage rates in those times? All of these factors play into where mortgage rates will go over the next year. So according to the experts right now, they're saying holding fairly steady in this low 5 range. And, that means that there could be a potential silver lining for buyers. And so I want to share this next quote with you, because if that is true, if mortgage rates do hold steady, I love this quote from CNBC. They're quoting Joel Kahn from the Mortgage Bankers Association. It says, there could be a potential silver lining for the market, he added, as stabilizing mortgage rates and rising inventory may bring some buyers back to the market during the second half of the year. So great news for buyers. We certainly do hope it's true that mortgage rates do hold steady. We're going to keep our eyes on them, and we're going to continue to keep you informed. Another question on everyone's mind, what is projected to happen with home prices? We just surveyed almost 400 agents and asked, what's the biggest question that your clients are asking you right now? It's about a crash and it's about pricing. They want to know, where are prices headed? Well, if you look at what the experts are saying, this is the home price forecast for 2022. We follow 7 key industry leaders on home pricing. These get updated some monthly, some quarterly. And if you look at them and average them all together, the average of all 7 is showing 10.3% home price appreciation through the end of this year. So, as we look at this year, we are certainly seeing a slowing, a decelerating price appreciation. Last year, we saw an average of 15%, according to CoreLogic. Homes appreciated by 15%. We're not necessarily looking at that much appreciation, but nationwide in most markets, experts are saying an average of 10.3% appreciation going forward. Now, I say nationwide and, in most markets, because I think this quote really is telling. It's from Mark Zandi at Moody's Analytics. It says, "I don't think the national housing prices will decline in a meaningful way, but there will be some price declines across the country." So you may be feeling this already in some markets that, there are pockets of the country that are overheated, that have appreciated significantly, that will likely see declines. It may already be happening where you are. But overall, because of, undersupply compared to demand, experts are saying a continued appreciation through the end of this year. So the other question that is on people's minds is, what does this mean for home sales? We've seen a little bit of a slowing in the pace of home sales. We've seen a softening in buyer demand due to those rising mortgage rates. So what does this mean for sales? Well, if we look at what NAR tells us, this is the projection for existing home sales. This is a seasonally adjusted annual rate in millions. So what this means, if you look at that green bar over on the right, NAR is saying that at the current pace of sales today, if we continue on this pace, we are projected to sell 5.1 million homes in this country this year. Now, look at that compared to 2020 and 2021. It's a drop off, right? Those were exceptional years. They were out of the ordinary, existing home sales through the roof due to all of the, record low mortgage rates, the changing needs of the pandemic, all the things. And what this probably feels like right now is this analogy you've heard us use so many times. Last year you were driving down the road at 80 miles an hour, you were cruising and you came around a corner and you saw the flashing lights, you slammed on your brakes and suddenly you're going 60, 65 and it feels like you're crawling. That may be what you're feeling right now when it comes to home sales. However, you're still going the speed limit, because if you look at the green bar compared to the pre-pandemic years, 2018, 2019, much more in line with pre-pandemic years. And let's not forget, those were great years in real estate. So home sales softening a bit, but still projected to sell 5.1 million homes in this country. And if we look at that from a total home sales forecast, this is from Freddie, Fannie, and MBA, we can see that those blue bars were what the experts forecast in January. That was before mortgage rates took their climb. And the reforecast in the green bars is the latest from July of 2022. So latest data we have right now, a little bit of a softening in total home sales. We sold about 7 million homes last year. We're looking more like anywhere between 5.8, 6.4 million homes for this year at the current pace. Now, again, still very strong years in real estate. And what I want you to think about too is that this is pretty typical for the experts to reforecast coming in, high at the beginning of the year. We see how the year is kind of shaken out and they reforecast. 2020 was a great example, reforecasted down, and then we exceeded expectations and sold a record number of homes that year. So, the reforecasting is very typical in the industry. So mortgage rates projected to hold fairly steady, home sales softening just a little bit, and prices projected to continue rising at a little bit more of a moderate rate in most markets. So what does all this mean? Well, it is actually a great visual to share with your clients is 3 reasons to buy a home today. If you think about the forecast, where home prices are, buying before prices rise higher, mortgage rates holding kind of steady, inventory is starting to tick up and come back to the market. There are 3 things that are happening right now that are creating a great scenario for your buyers, and it's your job to get this message out to them. We're seeing fewer multiple offer scenarios. So you can see in April, the average home sold had 5.5 offers. You look over on the left, it ticked down to 4.2 in May, 3.4 in June. That is a trend that we are seeing going forward. Fewer homes selling above asking price. You can see that percentage has ticked down from 61% to 51%. But don't get me wrong, still a very competitive market. If 51% or half of homes are selling over asking, this is definitely still a competitive market, but a better time for buyers to jump in if they're ready to find a home. And supply of homes for sale is growing. You can see that inventory, that month supply ticking up as the pace of homes sold and more homes came back to the market. So certainly not easy to find a home, but right now there's no doubt it's still very competitive, but definitely not as impossible as it may have felt for those who probably stepped out of the process last year or the beginning of this year. So great message to get back to your clients. And here's another great way to share it. This is the same data. We have this as an infographic. I put the link to this infographic in the notes to this slide. So 3 reasons to buy a home in today's shifting market. Great visual to get out there and share with your clients. So as we wrap up our monthly market report today, I want to talk about the 3 things we went over: what's happening in the current market, why the market won't crash, and a look ahead for the rest of the year. These are the visuals to get out to your clients, to ease their fears, to help them understand what history tells us, and for you to lead most effectively in this space to help your clients make powerful and confident decisions, so they can jump into the market when they're ready and can make those decisions based on what the data is telling us. There's a lot of fear, a lot of concern out there, and the data can help change that story for you and your clients. And before we go, I want to remind everyone that we have our fall buyer and seller guides releasing on September 2nd. Can't wait to get these in your hands. All updated information, especially about the shifting market and how your clients can succeed buying a home or selling a house this year. Thanks so much for joining us for your monthly market report, and we'll see you back next time.
All right, guys. Oh, what a wonderful report, Kate. Bueno, fue un excelente reporte para todos ustedes. Espero que hayan tomado los apuntes. Yo tomé varios apuntes para mí. I take notes, and I hope you taking yours. Y una de las cosas que me llamaron mucho la atención y que quisiera compartir con ustedes es el tema del mercado en el que estamos hoy. Como pudimos ver, todavía estamos en el mercado del vendedor. So we are in the seller market. And that means that if you are thinking to sell, so right now, it's still your opportunity to get the best price possible. So, si quieres vender, no te esperes más, porque como vimos en el forecast, los mercados van cambiando y se espera que para el tercer cuarto del 2003 podamos ver un mercado más favorable para los compradores. So, if you've seen in the forecast, still in the seller's market, but don't wait too much. Because if you see in the forecast, by the third quarter of 2023, the market is going to be changed and it's going to be more affordable for buyers. So don't wait. So in conclusion, if you're a seller, don't wait too much to sell, because this is very good time to get the most money for the property. If you are a buyer, si tú quieres comprar, creo que lo más apropiado y honesto de mi parte sería que esperaras un poquito más, ¿sí? De acuerdo con la lógica que estamos hablando. Sin embargo, Kate nos ponía algunos ejemplos porque era interesante comprar en este momento. So whatever it is your point, I just want to be really honest with you. If you want to buy, you can wait a little bit more. So maybe another 6 months, So in this point, you can save a little more money. You can put more down payment, and that way when you get more down payment, so your interest rate is going to be dropped a little bit more and better. So if you want to apply, always make a plan. So, si estás pensando en comprar, siempre te aconsejo que tengas un plan. Y dentro de ese plan, puede ser un plan de ahorro. So, in that way, you can save some money now through 6 months. So, some people, they are saving money very aggressively. I know one of those guys, and he is, renting at this moment, and just say, hey, you know what? I don't want to renew my renting because I'm going back to live with my family, and I'm gonna save all that rent in 6 months. I'm gonna save enough money to buy a house. So, esa es una muy buena idea. Uno de mis amigos está rentando, no va a renovar, su renta porque van a ir a vivir con la familia y van a ahorrar 6 meses de renta. Con esos 6 meses de renta más otro dinero que tienen, van a poder tener, digamos, un mejor down payment. So, si tienes un plan como este, sería bien interesante que empezáramos a mirar algunas casas, empezáramos a ver cómo el mercado se va moviendo para que en el momento indicado puedas tener entonces la compra de tu casa. So, para los compradores, if you're thinking to buy, so you start getting ready. So, getting ready, it's no compres algo muy grande como un carro o furniture, anything that they're gonna affect your income, your rates, la capacidad de endeudamiento, para que cuando estemos listos, esas compras no afecten tu calificación. So if you're getting ready for buying right now, don't get so excited to buying cars and furniture and things like that. It can affect your rates. So be smart and thinking that you can own your home next year. For sellers, okay, so this is the time. Inventory is still low. So we're gonna sell, maybe not in the same way that we were selling 6 months ago when we put house in the market. In one 2 days, it's gonna be many offers. But right now we have to keep it a little bit. So, however, it's a good time, still a good time now to the end of this year. So if you like this meeting or report, just let me know and I can send you the copy of this report to you. And also, if you want to talk to me, use call me or send me an email, put some comment in my social media. Again, my name is Diego Rios with West USA Realty, and it's going to be my pleasure to to talk to you and any conversation about real estate. Thank you so much. Bye.